This show is dedicated to helping you strengthen your family tree and live financially free. Welcome to the Marriage, Kids, and Money podcast, everybody. This is Andy Hill, and today we're talking about investing for our future. With options like the 401k, the HSA, the IRA, the 529, the 457, the 403b, good God, there are too many letters and numbers to make sense of all this. As young parents, where do we even start, man? So our guest today is going to help us make sense of all this investing madness. Andy Wang is here with us today. He is the managing partner at Runnymede Capital Management and the host of the Inspired Money podcast. He has been named among the Investopedia 100 most influential advisors, the top 100 most social financial advisors by Brightscope, and has appeared on Reuters TV, The Huffington Post, Barron's, and Forbes. Outside of his financial advising world, Andy is a father of 3 and loves playing the Hawaiian guitar. Maybe we can get him to do it a little bit today. Welcome to the show, Andy.
Thank you, Andy.
Oh, man,
that's
this is
a lot of confusing numbers, and then we'll confuse everybody by having 2 Andys on the screen.
Exactly. Let's confuse and then confuse a little bit more. So, Andy, there's a lot of young families that listen to this show, and a lot of them have debt. So what are your thoughts on paying off that debt versus investing?
Well, I think when it comes to investing, there's no right or wrong approach, and it's not one size fits all. And I was thinking about this because you mentioned that I have 3 kids, and it's sort of like parenting too. It's like you try to do all this research and figure out how can you be the best parent, but then each kid is different, so you don't know. And I think that investing and paying off debt is a little bit similar in that way, that you don't just open up a book and say, this is the strategy that fits everybody, because it matters, like, what's your cash flow? What kind of debt do you have? And like, are you going to sleep well at night if you have debt or not have debt? So everybody's different in that way. So it does take it requires taking a look at yourself, knowing yourself, in addition to just looking at the numbers.
I love that. I love that piece of advice because, there's a lot of fans of Dave Ramsey that listen to the show, and a lot of that is just, hey, here's what's in the book, this is what you should do, and everything else is maybe not the right way to go. So looking at it and kind of taking an objective view towards your situation and what fits well for you, and also where you're emotionally feeling. I love that point. That's a really good point. So, let's talk about some of the biggest challenges and reasons that people are not investing. I look at some of these articles about the amount of money that people have in their retirement, and you working in the industry, I'm sure it's your mission to help people figure that out. So, what are the biggest challenges or reasons that people aren't putting their money into retirement right now?
Well, there are so many reasons, right? I would say one of the biggest ones is that people just say that they don't have enough money to save and invest. I mean, right, month to month, you're just trying to pay your bills. And if you're struggling to pay your monthly bills, it's just not within your realm of thinking. Like, how can I invest? How can I plan for my future? But I think that your story is inspiring because you're teaching your listeners that it is doable. I think in most cases, it's like you've got your income and you've got your expenditures. All of us have room on the expenditure side to make some choices. And, there are definitely places that we can trim. Most of us can anyway.
Yeah. So it's a lot about just priorities, right? I mean, if it's a big priority for you, things might just have to adjust in your budget a little bit, right?
It's about priorities. And I love the advice that, before you even sit down and budget and try to figure out how much you're going to spend where, just track, because tracking, is like a much lower barrier to entry. It's less threatening. It's like, just track where you're spending and don't get too bogged down in the details. Just write down the big items. It's like your house, it's your rent or your mortgage, your food. It's like 3 big items, your car. Then you can try to see, what are the other things that where is your money going? And inevitably, if you're tracking, it's human nature that you're going to try to improve, right? I mean, you don't even have to try too hard. Once you are watching to see where is your money going, then you start seeing things. And, that's really powerful because you see, oh my gosh, I'm paying $200 a month for cable and I'm really not watching these movie channels. I don't need them. Or, you see where you can trim the fat and then you can make an impact. And those monthly bills that you're paying, especially for things that you're not using, I mean, that's easy, right? And you cut those and that's savings every month. So over the course of 12 months, it adds up.
Absolutely. Well, let's talk about some of the ways that people can save for their retirement. Some of these acronyms and numbers and letters and confusing things. So let's start with our 401k. So what are the benefits of your workplace 401k?
Well, I love the 401k because that's usually the easiest for everybody. And I think that the statistic is that 80% of Americans or 79% of Americans work for a company that offers them a 401k retirement plan. And, it's great because the contributions, the money that you put into your 401k, you're kind of getting like a double tax break in that the money that you put in doesn't count towards your gross income, right? So whatever money you put in, it's like the government doesn't see that right now. It lowers the amount of income that you're paying taxes on, and it's also you're able to grow that money tax deferred, so you don't pay taxes until you take money out. So that is great. And then the other thing is that it's automatic. So you're setting like what percentage of your paycheck are you putting into the 401k plan? And I think that's one of the best parts because it becomes automatic. You don't have to think about it. You can put it on autopilot. And in most cases, that's money that you don't miss once you set it and you can forget it. And of course, I mean, the most obvious thing is that if you are fortunate enough to work for a company that gives you a company match, then you've got to at least participate up to the company match because otherwise you're leaving money on the table. That's guaranteed money that is going to end up in your retirement account.
Yeah, that's free money. Yeah, we've got a match at my office, and I've been taking advantage of that for the past 5 or 6 years, and it piles up, man. Absolutely. So I completely agree with you. Take advantage of it. Make it automated. Do it fast. So
yep.
Go ahead. Yep.
Oh, automation's the best part, right? Because life gets in the way. It's like you want to go out. You want to go out with friends. You want to go out with your wife. You want to enjoy yourself a little bit, or inevitably your car needs to be fixed. I mean, I've been going through that recently. We have a 2009 minivan that probably should be replaced soon, but like all these unexpected bills keep arising. So life gets in the way. So it's important to have that automated part that, it's being socked away before you can even get to it. And that counts for a lot.
That's the point. Yeah. I mean, you do it and you just forget that you even had that money, right? So you wouldn't have spent it on other things.
Exactly. Yeah. It's good when you don't miss it.
So there's other terms for folks that work in a workplace, but they aren't using a 401k. There's 403b, 457. What's the difference between those three?
401ks, 403bs, 457s.
Yeah, why couldn't they come up with better names for these things?
It would be much better if they came up with easier names to remember. And then we'll talk about 529s too.
There you go.
Yeah, I think for most employees, for most plan participants, those who are using and utilizing the retirement plan, the numbers aren't that important. I mean, it's like the 401k is the most popular. It's just a retirement plan, retirement savings plan. It can be a profit sharing plan. It comes in different flavors. The 403b typically is offered by a nonprofit. So it depends on what type of company or entity that you work for. And the 457 is like if you're working for a local government or municipality. There are slight differences, I think, in the tax law or some subtleties in like I think the 457, you don't have penalties if you take out money early, whereas with the 401k and the 403b, there are. But to the participant, it doesn't really matter. There are slight differences, but the key is if you have a retirement plan offered to you, you should be taking advantage of it. And I mentioned that 80% of employees in the United States have access to a 401k or some form of retirement plan. Sadly, I think it's a much lower number of those who are participating. Mm-hmm. I see different numbers. I see like 30 to 40% are taking advantage. So there's a big gap there.
Is there like a hack then to just like, the difference between that? Like 80% are available and only, well, let's just say, for example, 30% are taking advantage of it. What can we do to close that gap besides the knowledge that we're sharing today? Obviously, is there a quick and easy hack that I could just do to make this happen for me?
Well, the hack is that you have to elect to like contribute. And actually the corporations have seen that. And in recent years, more and more companies are doing an auto enrollment so that there's a default. If the employee does not elect to contribute, they'll actually build it into the plan documents that, after a month of employment, it automatically happens. And then there's a default investment option, usually a target date fund. So if the employee does nothing, rather than having no participation at all, it happens automatically without their even knowing practically. And yeah, that's become a very popular option in 401k plans because the companies want their employees to be retirement ready. They don't want them to they don't want them to reach age 65 and say that I'm getting old. I really don't want to work here anymore, but I have no choice but to work here. I don't have the option to retire. The companies don't want that. So the companies have this auto enrollment feature that has become very popular.
That makes sense. You almost have to opt out then to
exactly. That's how it works. That's how it works. Yeah, you do have to opt out, and everyone knows that. Usually, the guy who's not paying attention at all, he's not going to opt out. He's neither opting in nor opting out. So it's better.
That would be funny. Somebody didn't pay attention for like 20 years, and they're like, "Oh, I got $1 million in here. What's that?"
Exactly. That's the whole idea. That's cool. A nice surprise.
Well, let's talk about that $1 million. So we've heard this term a lot, compound interest. It's something that's the eighth wonder of the world. Tell us what that is and why people need to understand what that is.
Compounding is magic. You must talk about compounding on your show a lot.
Oh, absolutely.
I mean, I'm sure that you've heard this, right? It's like your money has two best friends. It's compounding and it is time. It's like the more time that you have, and if you're able to compound, grow your money, that's how you're going to reach $1 million plus in 30 or 40 years. So the idea is a simple one. It's it's not just a straight line matter of if you contribute $1,000, if you make 4%, you've got $40. Each year, you're making interest on your interest, and that's where the magic happens. So yeah, compound interest is powerful, but if you're investing in stocks and bonds, then hopefully you've got compound growth. Right? There's risk there, there's variability, but if you can grow your money at 7% every year on average, that's going to be very powerful. And, we've seen very, very low interest rates. Things are getting better now than they were 5 years ago since, there was a point where it was close to 0% interest rate. At least now you could get 1% to 2% pretty risk-free. But if you can grow investing in the stock market in, 5% plus, 5 to 10%, that's where you're going to see the magic because compound growth. Yeah, the growth on the growth.
I love it. Your money making money, right?
And we always use the analogy of the tortoise and the hare. It's like usually boring is good. I mean, the water cooler chats are always like, oh, I invested in this biotech company that has this promising drug that's going to cure everything. And, that's extremely high risk. And odds are that people invest and maybe the stock goes up, but then suddenly, oh, the results weren't that good and comes crashing down. Usually boring's good. And that comes back to the power of compounding. It's like if you can find companies that grow, 10% every year, they're growing their earnings. That if they can grow their earnings every year consistently, then, those are the boring companies that are worth owning for 30 or 40 years. Because if the company can grow earnings consistently quarter after quarter, year after year, then shareholders will be rewarded. We like to call those kerchunker companies because quarter after quarter, year after year, the earnings just grow. Kerchunk, kerchunk, kerchunk. And as investors, you could sleep better at night because of that consistency. Or if you're an index investor, then you own the S&P 500, and S&P 500 earnings are pretty good. And it all comes down to earnings do matter.
That's great. I love that kerchunking companies. I'm stealing that
kerchunk,
one.
Kerchunk, kerchunk.
That's great. Well, let's talk about outside of the 401k, you've got the IRA. So can you tell us the difference between, we've heard traditional, we've heard Roth. How do I choose one or the other? What's the way to go here, man? We're all lost.
Oh my gosh. Well, again, you asked me at the start. It's like, how should you pay down debt? Should you invest? And it comes back again. It's like you have different choices. So hopefully, right? I think that some of the suggested guidelines are that it's like put 3 to 6 months away as an emergency fund so that you can withstand surprises, right? Like you need new brakes on your car or you lost your job. That way, you're not severely impacted, that you're prepared for rainy days. And once you have that, then you can make a choice. All right, pay down some debt, do some investing. My approach is usually all or nothing is really tough because there's a sacrifice made or opportunity cost one way or the other. So usually I like a hybrid. It's like you do a little bit of both. And I think that the same with 401k or IRA. There are pros and cons to each. I love the 401k, like I said, because it's offered to most people. It's automatic. There are actually pretty high contribution limits, so you can contribute a lot annually. If you have extra, then yes, then you have the choice of investing or opening up an IRA account, and you have some more flexibility there because you're not limited to an investment menu of fund choices and ETFs, hopefully. With the IRA, you can invest in anything you want, practically, right? You can own individual stocks, you could own individual bonds, you could own mutual funds or ETFs. Kind of the world is your oyster. And there are contribution limits there, but they tend to be lower than the 401k. So it's about choice. And like I said, I like a hybrid approach. I think that it's good to sort of use different vehicles because there are pros and cons to each. And I'm sure that we can talk about Roth and regular IRA too, but yeah, it's similar. It's,
so just talk about the general difference between the traditional and the Roth. So one is PreTax, one is PostTax. Is that pretty much the difference?
That's the main difference. It's like, do you want to pay your tax now or do you want to pay your tax later? And I think that the longer your investment horizon, the younger that you are, it makes a lot of sense to participate in the Roth. It's like you pay your taxes now and you grow your money tax-free so that 30 or 40 years from now, that money has compounded and your tax was already paid. So when you take that money out, you don't have the liability of having to pay taxes. I've heard the analogy that it's kind of like with the regular IRA, because it's tax deferred. You don't pay the taxes going in, you're growing tax-free, but when you take the money out, you have to pay the taxes. So therefore, that money is not 100% yours, right? It's like the government owns a little bit of that money. And it's a little bit like having a mortgage because you're looking at that pot of money and you say, well, that's my money, but it's not all mine. I'm going to have to pay some to the government. You can make that analysis and choice, do I pay the tax up front? That's kind of like making the choice to pay your mortgage down now so that you can be debt free. And with the Roth, it's like that's your money. You own all of that. You can account for all of that, and you don't have to pay anything to the government.
So do you like a little bit of, I guess, pre-tax, post-tax diversification then? Do you think that's a good strategy?
I like that strategy because there's so many variables that it's difficult to know the future. It's difficult to forecast, like, are there going to be changes to the tax law? You don't know, right? Congress could make changes that could impact you 30 or 40 years from now. And how does one even guess at like what that's going to look like? So I like having, it's like you participate in a little of both. There are pros and cons to both. It's diversification. It's like, just like with investments. If you're diversified with your investments, you also diversify your retirement type of accounts because you don't know exactly what the world's going to look like in 40 years. And then that way you've kind of, you're covered in different ways. And what I also like is that you can think about, they call it asset location. So with the Roth, because you've paid the taxes up front, you should be investing in, you should be investing in assets that have a higher growth, higher expected growth. So you could invest in small cap companies, for example. And over time, history has shown that small cap companies grow at a faster clip. And because of that, chances are that it can appreciate more. And then in your IRA, your regular IRA, you could have lower growth holdings. And that way you're maximizing your tax benefit.
I love it, man. This is great. Thank you.
So asset location.
Yeah, absolutely. Move it around, keep it diversified in all sorts of fashions. It makes sense. Well, let's talk about our kids. So, a lot of people listen to the show, I said, young parents, and they are considering, okay, I'm looking at this $1.5 trillion of student debt, and it looks like madness. How do I save my kids from this? How do I save for my kids' future college costs so they don't deal with this craziness?
Yes. With 3 kids, that is my real nightmare.
Top of mind.
That is the real nightmare that I am living. That's why I come into the office every day, because I know that I've got tuition bills coming much sooner than I can even imagine.
Oh, man. How old are your kids again?
They're 11, 8, and 6.
11, 8, and 6. Oh, yeah. It's coming up.
It's coming.
So how are you preparing then?
Well, I'm using the hybrid approach again. At our house, we have 529 accounts for the kids that we can contribute to. I'm fortunate that my parents, the grandparents, will also contribute some money into the 529 plans. And the 529s are great because they're pretty easy to monitor and they're easy to implement. And I like that there is a tax benefit. I mean, I kind of look at them as if it's an IRA account, because as long as you are using that money for qualified educational expenses, you're not paying any tax. And that's a good thing. I mean, if tuitions were not so high and increasing like much faster than inflation, then maybe you're worried about, what if I'm putting too much money, because the money that I don't use for educational expense, I have to pay a 10% penalty on. Sadly, that is not a concern, because I feel like no matter how much money you have in there, it's not going to be enough. So yeah, I'm just worried about, like, how can I put more? How can I sock away more in there and then just hope that the markets are favorable for the longest period of time so that it's compounding at a good growth rate?
So you've got 3 kids. So let's say somebody's listening, they have more than one child. Should they open up a couple of different 529s? Should they just have one?
You can go either way. And the reason for that is that if you just have one, you're allowed to use unused money in the 529 and, give it to a sibling or use it for a sibling. We set up 3 in our family because what happens if 1 and 2, you use the whole thing, and number 3, you don't have enough? I like the idea that each child has his or her own, and then that way we can keep track of like how much each child has. But then we have the flexibility still that it could be used for a sibling or somebody else.
That makes sense. So let's say we're doing pretty well, and we got enough money for our 401k, our IRA, and our 529. I've heard about doing Roth IRAs for your kids. How does that work?
How does that work? Well, we talked about the benefit of the Roth, and like the longer that you have, the better. So the Roth IRA is like really well suited to young kids because they have longer to invest. And if you pay the tax now, your child should have a very low tax bracket and isn't paying a lot of taxes. So pay it up front and then grow it for even a longer period of time. The caveat is that your child needs to have some earned income to qualify for setting up a Roth IRA. So, it's good. It's great if they're doing some babysitting or have a little side business set up. I know that your children I know that you have one in particular who could be like a future YouTube star. So she may be monetizing and making like a lot of money by the time she's 18. Who knows?
Yeah, we're working on that. We're working on that Roth IRA for her right now. She's getting more and more involved in the business this year. So we'll see how that works.
Yeah, she's a consultant too.
That's right.
To your side,
she's a star lately. She's been featured on the show and all sorts of fun stuff. So we're trying to figure it out. But yeah, we want to make sure we're doing it the right way. So that's why
official correspondent.
Absolutely.
For Marriage, Kids, and Money. Yeah, she can be part of your business and can earn income and set up a Roth IRA and start socking money away.
Absolutely.
And yeah, it's really good.
That's cool. So are there any other routes that we're not thinking about? We got 529, we got the Roth IRA. Anything else that is advantageous for us, or at least tax advantageous for us, for our kids to save for the future?
Well, there are a couple of things. And now that we're talking, my mind's like all over the place. One thing that we just take a step back for a minute. It's like we talked about Roth versus regular IRA. One thing that we didn't talk about is that many people in their 401k plan, that they also have that option, that they can do PreTax or Roth.
Absolutely.
That's a popular option now within 401k plans. So it's really the same thinking that applies. It's like, do you pay the tax now or do you pay the tax later? And one of the good things, though, with the 401k plan is that with a Roth IRA, with the Roth IRA, depending on your income, like it phases out, that you cannot contribute into a Roth IRA if you're making too much money. That does not apply to a 401k, a Roth 401k. So that's one thing to keep in mind. So if you're a high earner, you can sock away, like pay the tax now and put money away into the Roth 401k and grow that tax free. What else were we talking about? Oh, back to the 529s. Mm-hmm. Beyond the 529, you could also open up like a UTMA account, which is a custodial account. So there's the choice. It's like, do you go 529 or UTMA? Again, no hard and fast rules. I like the 529 because of the benefits that we talked about. The UTMA is it's an older vehicle. You can open that up, and where the 529 is sort of like a 401k, in that usually the state sponsor, whoever's sponsoring the 529, they're giving you investment choices, and you have some limitations there. With the UTMA, you could own stocks. It's like an IRA in that you can own stocks, you could own bonds, you can buy whatever you want. There's more flexibility there. But there are things to keep in mind, because the UTMA is harder for the parent to control, like how the money is going to be used. That money officially, depending on what state you live in, gets turned over to your child at age 18 or 21. And there's you lose control. So you better teach your kids responsibility and how to handle money, because that part of it you cannot control. That money becomes your child's money, and they technically could spend it on whatever they want. And there's not a tax incentive as with the 529 that if it's spent on education, you're not paying taxes. And if you don't, then you have to pay taxes. With the UTMA, I think that you have to pay income tax either way. So that incentive to go towards education is not built in. So just some things to keep in mind.
I love all these options. This is great. And, sometimes hearing all these things, it can be very informative, but it could also be a little overwhelming for people. So if they're thinking, man, hey, I want to save for my kids for college, but I'm really kind of not doing that great on my retirement, what's more important for young parents to think about?
Simplicity, right? It's like, well, with all finances, with all personal finance, I think that too many of us don't talk about money. We don't address money. Life gets in the way. I mean, too often, it's like people are not looking at their 401k plan even to figure out, like, do I need to change my investment mix? Because you just don't look at it. There are too many things going on. It's like you've got projects at work. You have to drive the kids to school. You're going to soccer practice. You have things to do. And everything financially related can too easily be put on the back burner. So keep it simple. It's like wherever you can automate, make sure that you participate. And, from there, you're just trying to make little steps to tweak things, like how can you make improvements? But the biggest thing is just doing it, right? You've got to do it because, like we said earlier, time and compounding, that's where the magic happens. So don't not participate because you're giving up on those two things. That's going to hurt you.
Absolutely. Well, let's keep on that frame of simplicity to keep this thing easy. But people want to dive a little bit deeper and learn a little bit more. Was there a book that you came across or a book that you've read recently where simplicity was the key and kind of kept things easy for people on investing?
Oh gosh, one book that I really like is Peter Lynch's book. And this is like the first investment book that I ever read, One Up on Wall Street. And it's not talking about all the investment choices, but it is talking about simplicity in that Peter Lynch was at Fidelity. He was running one of their most successful mutual funds for many, many years. And his whole approach was like, invest in what you know. And he was a stock picker, right? He was investing in individual companies, but the message is one that it's like stores that you're going to a lot and that your family is buying from, like you have a familiarity there and you kind of see it's like why the company is doing well, why it's popular, what you like about that brand. It's like he's saying invest in what you know, don't be doing things that are too exotic. And the whole idea, he talks about compounding too. He talks about like 10 baggers, meaning that companies that you invest in and you can increase your money 10 times.
Those are your ka-chunkers?
That's like ka-chunker, exactly. But yeah, I like the book for the simplicity, and it's an investor's book. It's like, don't make it so complicated. It's like you look around, what are you buying? Maybe you like Apple products, so you should own some Apple. And then it's kind of easier to do some research too because you have interest there as a consumer. And then to be a shareholder too, it's like a bonus. You're like, all right, I want this company to do well because it's going to benefit my investments.
Absolutely. Well, that's great. I had one more question before we go. You spent a lot of time talking about money. You're in the investing world, and sometimes people think, hey, the experts are always have it right and they have no problems. What's one big financial mistake that you've made in your life with regard to money?
Oh my gosh, I have more than one. I mean, I kind of laugh because in investing, like whether you're picking stocks or you're picking funds, it's always about managing risk, which means how do you make fewer mistakes? Like we all make a lot of mistakes, but if you can limit your mistakes, that's how you're going to win at the end, which is kind of like sports too, right? It's like, all right, I'm going to make a lot of errors, but let me try to learn from them as quickly as possible and limit the errors, because if I can do that better than my opponent, then you're going to win the game. So yeah, I think as a financial advisor, too often it's like the shoemaker. It's like the shoemaker's kids have no shoes because the shoemaker's too busy making shoes for the customers. So yeah, I had an element of that. I think that certainly in my 30s, yeah, we're always paying attention to our clients' accounts. And then at year end, I would look and say, hey, look, the clients did really well. Wait a minute. My own account, I'm not paying attention to. And, that's terrible. So, yes, with age comes wisdom. And we would actually have, because I'm in a family business, I work with my father. He founded Runnymede Capital. I work with my brother. And we have meetings. We have investment team meetings. And we would say, wait a minute, you know what? This is a great company. All of our clients own this company. How come we don't own this in our own portfolio? So it's working on things like that we make sure that we don't want the shoemaker's kids to have no shoes. It's like we have to participate too. We can't miss out. Time and compounding is important. So we have to make sure that we are taking care of our finances as well as for our clients.
I love that. My takeaway from that, Andy, is that if I don't take advantage of the advice that you gave me today, then I am not taking advantage of the information that I have. So I like that. I like that, my friend. Very cool. So, Andy, are you guys taking clients right now at Runnymede? Is this an opportunity for us to send people your way and get some more business, or where are you guys right now with Runnymede?
Absolutely. No, like I said, it's a family business. My father started it 25 years ago. So it's like father and sons. And with the second generation in place, me and my brother, we definitely want to grow the company. We're constantly trying to figure out how do we take the knowledge that our father has taught us about investing. He was previously director of research at the Bank of New York. He ran their money management subsidiary where he was managing their pension fund and outside clients. So that's what we do. I mean, we manage portfolios for people. We do some financial planning for people to help them to plan for retirement. And yes, we want to help as many people as possible. So yes, we're taking on new clients and enjoy the aspect of working with clients to help them. And we're fee-only advisors. So we're not selling products. We don't get paid commissions. Our interests are aligned with that of our clients. We want to grow their money and protect their money. And we get paid on that. So
that's great.
We think it's very fair.
That's great. That's the kind of partner you want, everybody. It's somebody that's there that's looking for you and not trying to sell you products that you don't need. So if you want to dip your toes in the water and learn a little bit more about Andy, you guys have a great podcast. Can you tell us where people can find that?
Absolutely. Yeah, thank you. The company website, Runnymede Capital, is runnymede.com. That's RUNNYMEDE.com. And if you cannot spell that or cannot remember how to spell that, it's much easier. Inspiredmoney.fm, which will take you to the same place. And I've been having a lot of fun with the Inspired Money podcast because it's money related, but I get to talk to all kinds of interesting people to put money in a positive light so that it really inspires us to have conversations about money, to think about our money, to address our personal finances. And it's just a lot of fun talking to different people about money and, what drives them, motivates them, where their passions are, and then get a little tips from them on how to succeed.
Absolutely. Well, Andy, thanks so much for being here today, and I look forward to hanging out with you again at a conference. And we had some fun last year, guys, going out to restaurants and having a good time at the conference we go to, FinCon. So I'm looking forward to hanging out again, buddy. And thanks so much for imparting some wisdom with us today.
Well, thanks for having me on. It's a lot of fun to hang out with you. Andy Hill is like the happiest, most enthusiastic person in a genuine way. So. Yes, you're a great person to talk to in the morning because the rest of my day is going to be just like a little bit brighter.
I love that. Well, that's what happens when you put two Andys together, right?
Magic. Magic.
Thanks again, man.
Thanks, Andy.